Mr. Robert Allen on, teaching us about multiple streams of income and a little bit about the stock market. Now, as you recall, one of the things that we want you to do is to spend your time and your energy making more money. And you do that by starting small businesses and side hustles, making more money at your job, and doing those things that actively take your time. Then we want to take that money and put that into S&P 500, Berkshire Hathaway, so that it can go out there and make more money. Now, for the vast majority of you, and the vast majority of me, that's where we need to spend our time. Now, one of the things we want to expose you to is some accelerated stock ways of doing this. But for the vast majority of you, if some of you are just want to invest in the stock market, it's fascinating to you. You like to watch it. You like to put your money into companies that you think are going to go up, and you do a lot of studying and like that, and that's great. But for the most part, you don't have enough money under management. You're not managing enough money to spend your time doing that. You're better off putting that money into the 500 biggest companies out there, the S&P 500, or into Berkshire Hathaway with Warren Buffett, because those are massive companies and they're managing all that for us. Then we spend our time doing other things. But I want to expose you to some of these other techniques that you can use. And if you really want to be able to pick and choose some of the stocks, we'll take a small portion of it, of what you have, and then pick and choose the different stocks that you want to buy and the different techniques that you want to use. And then if you are really, really good at it, and you have a pretty good sized pile of money to make it work, then you can spend a lot more time picking and choosing and doing some of these other techniques. But for the most part, most people don't have the time, and they're just not that great at it. Remember, for every winner, there's a loser in the stock market, because everybody, somebody's buying, somebody's selling, and everybody's paying a commission. That's why Warren Buffett says his favorite hold time is forever, because he knows that as long as he's holding on for long term, that the net will be better. So I want to bring Robert Allen. We're going to talk about some accelerated stock programs. So for a small portion of you and a small portion of your assets, if you want to do this, then this is a great place to learn. All right, let's bring Bob in.
Chapter 6, Accelerated Stock Strategies, 6 Ways to Magnify Your Returns. So, you want to be more aggressive with your investments. Well, hold on to your hat. We'll start slow, but by the end of this chapter, we'll be flying at Mach 3. This chapter will teach you how to invest the portion of your stock portfolio designated for your moderately aggressive basin, earning 20 to 100% on your money annually. I encourage you to put a firewall between each of your investment basins. Never dip into your long-term basin to fund a shortfall in your short-term basin, and vice versa. Each basin is sacred, designed for a specific use. Using baseball language, your long-term, low-risk basin is designed for walks, bunts, and singles, 10 to 20% return per year. Your medium-term, moderately aggressive basin is for doubles and triples, 20 to 100% per year. Your short-term, highly aggressive basin is for home runs, 100% per year and more. In this chapter, let's learn how to beat the market. Wait a minute, in Chapter 5 I told you it was almost impossible to beat the market. Yes, it's almost impossible, over a long period of time. But a large number of people have done it, on a short-term basis, and some people are doing it this very second. Don't believe me? Just for fun, stop reading, fire up your computer, and log on to www.morningstar.com. Morningstar is one of the top performance tracking services for mutual funds and stocks. Best of all, it's free. On the main page, scroll down to Toolbox and click on Fund Selector. When prompted, you want to scan all funds for 1-year returns. For example, on the day I did this search, there were 9,082 mutual funds of all types, from which the computer produced a list of the hottest funds for the previous 12 months. If you had picked any of these 20 funds, you would have more than doubled your money in that year. Wow! But 20 funds out of a universe of over 9,000 funds is only 1/5 of 1%. That's like betting on a horse with odds of 500 to 1. Would you risk the rent money for that? Sure seems tempting, doesn't it? Some people view the entire universe of mutual funds as a horse race. Some funds race off ahead while the rest of the pack trails. Then the lead horse surrenders the lead to another pony, who sprints to the front. This lead pony then falls back as yet another contender surges ahead. All the way around the track, the horses keep exchanging the lead. In this race, however, there are more than 9,000 horses, and the race ends on December 31st every year. One of the horses is called the S&P 500, which represents the top 500 companies in North America, if not the world. All other horses are trying to beat this horse. In most years, the vast majority of horses finish far behind the S&P 500 horse, especially when you factor in taxes and operating costs. Those horses that beat the S&P 500 do so only temporarily. But as the Morningstar list in Table 6.1 shows, a handful of horses finish spectacularly in the short run. The question of this chapter is, how can we locate these horses? In the next few pages, I'll share with you 6 ways, systems really, for finding funds and stocks that have the highest probabilities for not only beating the market, but trouncing it. We'll start with the easiest suggestion. System 1. Let the master himself manage your money. Who is the master of the investment world? Warren Buffett. He is without question the greatest stock investor of all time. Buffett doesn't believe in splitting his stock price, so if you want to own a piece of it, you must write a very large check for even a single share. In essence, Berkshire is Buffett's own mutual fund. A $10,000 investment with Buffett when he began in the mid-1950s would now be worth over $200 million. When he passes on to the big board in the sky, his stock price will probably take a temporary dip. This is just my guess. But then the results should continue pretty much as they have for years. Why? The co-chairman of Berkshire is Charlie Munger, who is less public but certainly as important to the success of Berkshire. The companies that he and Buffett have selected are exceptional long-term winners. The Berkshire Hathaway management team consists of only 12 people, all thoroughly trained in the Buffett methodology. As Buffett himself has written, "On my death, Berkshire's ownership picture will change, but not in a disruptive way. First, only about 1% of my stock will have to be sold to take care of bequests and taxes. Second, the balance of my stock will go to my wife, Susan, if she survives me, or to a family foundation if she doesn't. In either event, Berkshire will possess a controlling shareholder guided by the same philosophy and objectives that now set our course. You can be equally sure that the principles we have employed to date in running Berkshire will continue to guide the managers who succeed me. Lest we end on a morbid note, I also want to assure you that I have never felt better. I love running Berkshire, and if enjoying life promotes longevity, Methuselah's record is in jeopardy." Buffett further states in the owner's manual, "Charlie and I cannot promise you results, but we can guarantee that your financial fortunes will move in lockstep with ours for whatever period of time you elect to be our partner. We have no interest in large salaries or options or other means of gaining an edge over you. We want to make money only when our partners do, and in exactly the same proportion. Moreover, when I do something dumb, I want you to be able to derive some solace from the fact that my financial suffering is proportional to yours." By the way, if the high-octane Berkshire Hathaway, BRKA, is too rich for your blood, you can always buy the Berkshire Hathaway B shares, called Baby Berkshires, BRKB. They were created in 1996 to fill the void of those who couldn't afford the mama stock. Each Baby Berkshire is 1/30th of the price of the A shares, with a few less benefits. A quote from the Berkshire homepage is appropriate here. "If you don't know jewelry, know the jeweler." I'd add, if you don't know horses, know the jockey. Warren Buffett is the winningest stock jockey of all time. If you want to learn how to do what Buffett has done, and perhaps even duplicate it yourself, then you must read Buffettology, the book I recommended in Chapter 5. System 2. Select mutual funds with the longest term track record. If you don't want to bet on Buffett's selection of stocks in Berkshire Hathaway, then perhaps you'd like to choose another mutual fund to beat the market. Let's assume you could select only one of 2 funds. One fund has consistently beaten the market with a 20% per year compounded annual return for the past 10 years in a row, compared to 17.2% for the S&P 500. The second fund earned a whopping 176% in the past 12 months alone. outpacing the entire 10-year track record of the market in a single year. You're at the betting window, trying to choose between these two horses. Do you go with the hot hand or the consistent winner? Make your choice. The horses are at the gate, restless in their stalls. You rapidly juggle the numbers in your mind. If the hot fund could repeat its performance for only a few more years, you would be rich. Images of yachts and jewels and exotic places bounce around your brain. You could get used to that. Get rich slow or get rich fast. The choice is thrust in your face every day. You read a Money magazine ad boasting that this new fund burst out of the gate and grew at 52% in its first year. In the fine print, you read the familiar caveat, past performance does not guarantee future results. On the next page, a similar ad boasts a much lower one-year return, 16.5%. You flip back and forth between the ads. They both seem so real, so seductive. All things being equal, wouldn't you choose the fund with a bigger number? Remember, by the time that you read about these spectacular results in the press, the race has already been run. Can these horses do it again? For the answer to this, we dig a little deeper into Morningstar and find out how many of these winning funds were on the list in previous years. This narrows the choices down dramatically. Only 2 of the 20 were on the list 3 years in a row. If you had been smart enough 3 years ago to sink all of your money into either of these funds, the odds are about 1 in 7,000 that you would have selected the hot fund. If you go back 5 years, none of the funds did well 5 years in a row. Now we're starting to see the problem. More than likely, the hot fund this year will not repeat its success the next year. In fact, if we look at the list of the highest producing funds in each of the previous 1, 3, 5, and 10-year periods, not one fund made the top 20 in all of the time periods. Not one. In other words, the hot horse was not able to remain at the front of the pack. Of course, this is hindsight, but it sheds some light on the problem. Choosing a fund based on a short-term track record simply doesn't work. In fact, it might even be an indicator that this is the last fund you should be putting your money into. Excellent short-term results may be the clue that you should run for cover. It would be nice to be on the horse when it surges to the front of the pack and then ride it for all it's worth. But how can you find this fund before it makes its move? That's the trick. There's a way to do it, but it's fairly risky. So I'll save it for a later chapter. For now, let's go for the more conservative alternative over the past 10 years. There have been funds that have beaten the market year in and year out, over a long period of time, and it's relatively easy to find them. Once again, we turn to Morningstar and a screen of all the funds in the Morningstar database for the highest total return over the past 10 years. On the day I searched, there were 1,630 funds that had been in existence for the previous 10 years. Here's the question. How have these funds been able to pull off such long-term spectacular results? Was it the manager? Was it the fund strategy? Was it because of the bull market? Will they do as well in a bear market? Will any of these funds do as well in the next 10 years as they have in the past 10? Obviously, they've done something right. Let me give you 2 ways to narrow the list of 20 down to 1, 2, or 3 that you might be willing to put some of your money into. Number 1. Let me give you 2 ways to narrow the list of 20 down to the 1, 2, or 3 that you might be willing to put some of your money into. 1. Expense ratios. All things being equal, the fund on the list with the lowest expense ratio will probably have an edge in the long run. For exhaustive proof of this point, read Common Sense on Mutual Funds by John Bogle. 2. Industry group performance. All things being equal, the fund that has consistently performed in the top quartile compared to all other funds in the same market segment will probably have an edge over the next 10 years. Take a look at Figure 6.3. When it comes to quartile analysis, John Bogle, elder statesman of the index fund industry, has this to say in his excellent book Common Sense on Mutual Funds. When I evaluate mutual funds, and I have looked carefully at many hundreds of them during my long career, I like to look at a fund's ranking among other funds with similar policies and objectives. Morningstar Mutual Funds makes these comparisons easy. It shows in a simple chart whether a fund was in the first, second, third, or fourth quartile of its group during each of the preceding 12 years. For a fund to earn top performance evaluation, it should have, in my opinion, at least 6 to 9 years in the top 2 quartiles and no more than 1 or 2 years in the bottom quartile. I would normally reject funds with 4 or 5 years in the bottom quartile, even if offset by the same number in the top quartile. All of the preceding criteria can be determined with a little more digging in the Morningstar data. If you want to take a little more risk and venture beyond the plain vanilla index funds described in Chapter 5, then this would be a sound strategy. There is no guarantee that a fund you select this way will continue to be a winner in the future, but it stacks the odds in your favor, and probably gives you a better chance than a monkey throwing darts at a newspaper, if that makes you feel any better. System 3. Select only financial advisors with the longest track records. I've been to a racing track only a handful of times in my life. A friend of ours owned a racehorse and invited us to Del Mar to watch it run. It finished 5th. As we walked onto the grounds, there were several booths of people hawking handicapper newspapers that offered advice on which horses to bet on. Supposedly, these experts had taken all factors into consideration, the horse, the jockey, the track, the weather, etc., and were willing to share their top picks for a price. Although the stock market is not a betting track, there are hundreds of experts who will sell you their analyses. 4. Let your portfolio go to the dogs. O'Higgins' approach is deceptively simple. Rather than rooting around in 10,000 individual stocks to find the ones with the greatest chance of success, he urges us to narrow the universe to only the 30 stocks that make up the Dow Jones Industrial Average, the most widely followed stock index in the world. From this universe, he shows you how to find the few stocks on the list that have the highest probability of increasing in value in the next 12 months. All of this research takes 10 minutes per year. You make your choice, invest your money, and don't do a single thing until the next year, when you perform the same simple 10-minute calculation and reshuffle your portfolio. Sound too hard for you? Now you know why his book became so popular. People are still talking about it over a decade later. In his most recent book, Beating the Dow with Bonds, Mr. O'Higgins states, "My stock-picking system for beating the Dow is predicated upon the idea that the out-of-favor or worst-performing companies on the Dow, my pet Dow dogs, do a lot better over time than the top or best-performing ones. My 5-stock formula is the simplest way to outperforming the Dow with that strategy. It uses a combination of the highest yielding and least expensive stocks to structure a 5-stock portfolio. This has the incidental advantage of requiring less capital because of fewer stocks and lower prices." Why these 30 stocks? You can see that they are extremely successful companies that will be around for decades to come. The only trick is to determine which of them is going to do the best over the near term. Look at the list again. Without a crystal ball at the beginning of the year, how could you know which of these stocks to invest in and which to avoid? With hindsight, it's easy to see the winners and losers. The best one increased in value by 122.6%, and the worst one lost 57% in value. O'Higgins' approach is to create a small portfolio of 5 stocks that, as a group, have the greatest probability of outperforming the 30 stocks as a whole. Here is how O'Higgins tells you to do this. 1. Buy a copy of the Wall Street Journal showing the closing prices on the last business day of the year. Actually, it shouldn't matter which 12-month period you choose, as long as you do it consistently, and gather information about the closing stock price and the dividend yield for that day. 3. Rank the yields by circling the 10 highest yields. 4. Rank the circled stocks from 1, highest yield, to 10, lowest. You have now identified the 10 highest yielders in the Dow. 5. Identify the lowest priced high yielders. Put a check mark next to the 5 circled stocks with the lowest closing prices. You have now identified the 5 stocks combining the highest yield with the lowest prices. Even if these steps seem like too much work, and look up the current dogs of the Dow list. All of the selections and day-to-day performance records are right there for you, free. What did we do before the internet? Some people have written that the dogs of the Dow approach has gotten so popular that it has lost its edge, as the most recent performance results seem to indicate. O'Higgins himself has refined his approach in his recent book entitled Beating the Dow with Bonds. In this book, he still touts the power of his 5-stock portfolio, but feels that the entire market is currently overpriced. Therefore, he counsels that there are many years when an investor should not be in stocks at all, but would do substantially better with either a fully vested position in U.S. Treasury bills or U.S. government zero-coupon bonds. He states, "My beating the Dow 5-stock strategy is still the stock-picking system to beat when the investment class of choice is determined to be stocks. but it no longer responds sufficiently to the overall needs of investors in today's market because it is only one-third of a strategy. My new strategy of allocating assets among and between the three major investment sectors closes the loop by being more well-rounded. It is the complete strategy for winning, not just in today's market conditions, but all market conditions. In other words, O'Higgins recommends switching your entire investment portfolio into one of three investment vehicles: the 5 dogs of the Dow stocks, U.S. Treasury bills, or U.S. government zero-coupon bonds. Knowing when to switch from one investment vehicle to another is a fairly simple process. Step 1. On or about January 1, buy the latest issue of Barron's weekly financial newspaper. Step 2. Locate the section of the paper that lists the Standard & Poor's Industrial Index. Step 3. Locate the latest U.S. Treasury bond price quotations. You are looking for the most recently issued U.S. Treasury bond scheduled to mature in 10 years. Step 4. Do some simple math. Add 0.30% to the number from Step 3. Then compare this number to the figure circled in Step 2. If the stock yield, 2, is higher than the bond yield, 3, this is your signal to invest your money in stocks that year. Just follow the 5 dogs of the Dow strategy mentioned earlier. If, however, the bond yield is greater than the yield on stocks, this tells you that stocks are overpriced and ripe for a correction. Your money should be invested elsewhere. Exactly where you invest your money depends on the price of gold. Don't ask me why, but O'Higgins has done the research to back up his selection. Step 5. Go to the section of Barron's which lists the gold and silver prices and note last week's price of gold per troy ounce. Also, circle the price of gold as of 1 year ago, as illustrated in Figure 6.7. Step 6. Compare the price of gold last week to the price of gold 1 year ago. If the price of gold is higher last week than last year, then invest 100% of your available money in U.S. Treasury bills due to mature a year from now. If the price of gold is lower last week than a year ago, then invest 100% of your available money in U.S. government zero-coupon bonds that are due to mature in 20 years or more. Then, according to O'Higgins, sit back, relax, and do nothing but watch your returns come in for the next 12 months. Then, on or about January 1st of next year, go out and buy Barron's again and revisit your investment strategy. Follow the same procedure every year thereafter. And that's all there is, folks, to my new Beating the Dow with Bonds strategy. Told you I kept it simple. To show you how powerful the strategy would have been over the past 30 years, as soon as the dogs of the Dow became popular, other people came out of the woodwork with their own selection process for picking the right stocks from the Dow 30. The Motley Fool duo of David and Tom Gardner came up with a variation called the Foolish Four that they track on their website. There is a huge difference between the top stock of the Dow 30 and the bottom one, 122.6% and minus 57%, is a massive swing of 179.6%. Therefore, it's worth the effort to come up with any kind of system that works. System 5. Consider enhanced index funds. So far, we have looked at 4 strategies. Strategy 1. Riding the coattails of a single-time tested brilliant investor, the legendary Warren Buffett. Strategy 2. Relying on the management of mutual funds with the best long-term track records. Strategy 3. Relying on the financial advisors with the best long-term track records. Strategy 4.